Morning, everybody. It looks like everybody's here now. Very good morning to you all. Thank you very much for joining us this morning. For those who haven't virtually met me before, my name is Marie Wadeson. I'm a managing director at K3 Capital Group, where, amongst other things, I'm responsible for the K3 Hub, which is a member network for professional advisors developed by a number of brands within our group. Since we launched in the spring of 2021, over 3,500 like-minded professionals from across the country have joined our network, through which they access a range of CPD and training sessions not dissimilar to today's event. A few pieces of housekeeping, if you will just allow me to do so before we get on to introducing our speaker today. So we are recording today's session, as you will have seen as you joined. The recording will be placed onto the K3 Hub website and the Quantuma website next week. Q&A function is open, so do feel free to get involved and ask questions as we go along. I'm going to hold your questions till the end and put them to our speaker. We have had quite a few come in already. Because I'm chairing our Q&A today, if you wouldn't mind just using the Q&A function within Zoom rather than the chat, just so I've got everything in one place, I'd be grateful to you. And finally, we're going to post a PDF of the slides into the chat shortly. And I would imagine that the team in the background running this for us today will do that periodically throughout today's session. Onto our speakers today, then, in that case. So I'm very pleased to be able to welcome Scott Peters, who is a colleague of ours from Quantuma. He's a managing director based in Birmingham, heads up our Midlands corporate finance and national debt advisory practices. He's a robust background in debt fundraising and has a comprehensive understanding of the corporate finance transactions. During today's webinar, Scott will explore the traditional debt versus equity funding debate that has become oversimplified, with a sophisticated spectrum of capital options to find the right funding mix, navigating the new funding reality of the UK capital markets following the sharpest structural shift in the last decade, and then the key factors affecting successful succession planning, avoiding the pitfalls that erode value, and when to start thinking about succession. Scott, thank you very much for joining us today, and welcome to K3, where you're making your debut. Over to you.
Thanks very much, Marie. So, hello everyone, and yeah, we'll sort of crack on and get onto the next slide if that's okay. But yeah, thank you for sort of joining us all today. So I'll sort of start on the next slide, just talking around the current debt markets, and so I'll sort of go through debt and equity, and then we'll sort of go through and look at the spectrum of capital first off. But this is a quick snapshot and perhaps a little bit out of date because this dates to around mid-July 2023. But you can still see here that despite there being a rise of private credit or debt funds or so on and so forth, that actually, banks still represent over half of all lending in the UK to businesses, and are still a key part of the ecosystem. That's a very different picture to where America is, where debt is a bit more commoditized and perhaps it's separate from the banks. We're also a little bit out of date here in terms of, I've just checked our latest numbers. I think we've got 253 debt providers registered now, which sort of shows just how much that market has expanded. I think one of the things that's very clear with the way that interest rates have moved, and we've moved from a low interest rate environment from the financial crisis through to just before the pandemic to where we are now, where we're sort of at sort of 4% base rate. One of the big advantages of a higher base rate is that there is more profit in lending for banks effectively, which means that the availability of capital improves, and that sort of changes the dynamics in this market as well. Fundamentally, though, when you go out and try and raise debt in particular, debt, it tends to be backwards looking in the sense that they need to be repaid immediately from the point that they start to lend to you. So they tend to be a little bit more interested in the way that your business has traded historically. And they tend to look at sort of three different factors, which would be, what's the management team like? What's the security net like? And ultimately, what's the serviceability like? And those are the three factors that all lenders will take into account. And I guess that sort of factor there will be, those factors will have different priorities depending on the lender that you speak to. If we could just move to the next slide, please. I think this just talks around here the debt market and where we're currently at with the debt market. And I guess in a nutshell, obviously debt's a bit more expensive now, but actually it's very available, to the point where, and we'll talk about equity in a minute, that actually we're in a very unusual particular market at this point in time where, normally you would, and we'll talk about the spectrum of capital later, where as you move through that spectrum, the risk goes up, the cost goes up, and the amount of control that you have to give away goes up. And generally speaking, equity is higher risk than debt, and therefore, if your business is high risk, you might find it easier to access equity than debt. However, in the current market, that's not necessarily true, and there are macroeconomic reasons as to why that's not true. I mean, first off, obviously there is more profit in debt at the moment, and I think the banks have woken up to the fact that they would like to, do some more lending, which means that at the moment we've got, a very good market for accessing debt, although admittedly at a price, as in it is more expensive. But secondly, we've come into a very, very unusual part of the private equity cycle as well, which we'll talk about in a bit. But what does that actually mean? Well, it does mean that you can access funding from mainstream banks now that perhaps 2 or 3 years ago they wouldn't have been interested in doing. It does also mean that the private debt or a debt fund or private capital markets, however you want to call it, have to be a little bit more creative in what they're doing. And certainly as we went through sort of the back end of 2015, 16, 17, we were seeing situations where banks didn't want to do much more than 2 times EBITDA leverage, and in certain sectors, and the debt funds would say, well, okay, well, we'll go to 3 times. Well, now that situation is expanding out, and debt funds will go to 4, 4.5, 5. In the larger corporate space, going pushing 6, 7, or even 8 times EBITDA. Now, that's not necessarily how they would credit assess it, but that's where they end up as a sort of factor, and that does sort of tell you that the availability of debt is improving. However, the important thing for businesses to understand, and I guess if there's a lot of accountants on the call today as well, this is an area that I think a lot of the clients perhaps need some support with, is that there's the return of the business case. And I remember when I was sort of starting out in banking, and it was very critical for us to see the business's business plan, and the business case for their funding. And then as debt got very cheap, people started to not look at it so much, because if you can borrow money at sort of 3 over base and base is at 0.1%, well, the business case probably writes itself, providing you can make some sort of money out of what you're planning to do. So people have started to perhaps lose the art of doing a business case and a business plan. But now with base rate being at 4%, if you're going to borrow from a bank and maybe the right rate of that is 3 over base, and you're looking at 7% interest, you've got to make sure that whatever you're doing is actually going to generate enough money to justify that cost. So I think the art of the business case and the business plan needs to make a bit of a return to the market, and it is a skill set at the moment that perhaps people haven't had to use over the last sort of decade or so, that's now coming back in. If we could just move to the next slide, please. So I mentioned that private equity is in a very unusual space at the moment, and we have seen an unprecedented movement in private equity in terms of staff moving from one fund to another. And that's typically a very sticky market, because people that work in private equity are invested in the opportunities that they've sort of deployed. So they tend to be involved in the carry. Now, there's a couple of reasons why we've seen that shift of people. And the first of those is obviously changes to the tax regime and remuneration that's made that slightly less appealing, and ultimately freed up people moving from one fund to another. But even without that, the second factor is just where we're at in that private equity cycle, and it is one factor that it alludes to where we're at in that cycle. So typically a private equity fund, and that's true for mid-market private equity, that's true for venture capital funds as well, they will tend to raise money on 5-year cycles. And that means they'll go out to market to their limited partners and raise a fixed fund, and they will deploy that fund over a 5-year period. And then after that 5-year period, they will sort of try and sell those. So in an ideal world, if you deployed money in year 1, you'd sell it in year 6. And if you deployed in year 2, you'd sell it in year 7. So you have 5-year deployment, 5-year realization cycles, and every 5 years you raise a new fund, broadly speaking. Now, what happened when COVID hit was that a lot of funds went to market in 2020 and basically recycled their funds into a new fund and said, look, it's a complete disruption partway through our cycle. We're just going to hit the reset button. And a lot of funds went out to market in 2020 to hit that reset button and recycle their previous fund into a new fund. That's had the effect. We're in 2025 now, which is 5 years on from 2020, and we are now seeing that 5 year deployment cycle come to an end for a lot of funds that have synchronized at the same time. Now, that does mean that the LPs have been tapped at the same point in time, which has made fundraising harder this year. And I know a lot of private equity houses have raised smaller funds than they would like, or have raised funds or have been unable to raise funds and are therefore moving to a deal by deal fundraising model. Or they're delaying fundraising to future years, or so on and so forth. So private equity is at a historic, low point in its ebbs and flows, effectively. And that's meant that this year, what we've seen is, in terms of numbers, I say relatively low deployments from private equity, and, trade transactions taking a lot more sort of precedence. I expect that to sort of reverse over the next few years as those new funds start to get deployed and PE houses perhaps try and shift out of phase. But we have got a very unusual circumstance here. The second circumstance, which we sort of touched on very briefly on the other slide, is family offices. Now, if you're a family office or a multi-family office working for multiple families, you are trying to deploy the private capital of wealthy individuals into opportunities that are perhaps off market. Now, one of the ways you can do that is by investing as a limited partner in a private equity fund. Um, Obviously, with the advent of artificial intelligence, those communication lines are shortening, and it makes it easier for a thinner staff structure to be able to assess unusual opportunities, and we are seeing that actually those routes to market are becoming more viable as well. That sort of coincides with the other thing that's going on in UK PLC as a whole, which is that there's a lot of businesses that are having challenges right now. Growth is relatively anemic in the UK economy. And what you're actually seeing is that um, every single opportunity's got just a little bit of noise in the background, whether it's a little bit of a bump in trading or whether it's some headwinds coming, and nothing is completely straightforward to the point where it's not just a rubber stamp from private equity, and people are having to look at things extremely carefully and closely. And that then leads to opportunities where people that don't have a fixed funding criteria, like private equity, can benefit. So we are seeing a rise in terms of family office deployments into opportunities that would traditionally be looked at by private equity. And if we can just sort of move to the next slide, I'll just sort of go through a little bit. I don't want to go into lots and lots of detail about sort of the pricing and so on and so forth. And this is perhaps more from a debt point of view here. But generally, we've talked about private credit and debt funds, and we've talked about what I'd call regulated entities. And those regulated entities like banks or merchant banks, basically, they work on a PRA authorized model. And the advantage that you have of being a regulated entity is that you don't actually have to have all of the money you deploy. I mean, if a debt fund lends you £1, they need to have £1 to lend you. But if a bank lends you £1, it needs to hold a certain ratio of tier one capital effectively, which in a fractional reserve banking world means that they perhaps need to have 12p somewhere in a current account for that pound that they've lent you. And what that means is that they have a slightly different way of assessing returns. A fund, and this is a private equity fund or a debt fund, actually work in exactly the same way. They have an internal rate of return. They private equity might set that around 30%. So what 30% IRR effectively means is that for every pound they lend you, they want £2 back in 3 years or £3 back in 5 years, which is why you might hear people talk about 2x and 3x money multipliers. It's a simpler way of talking about that internal rate of return. How a debt fund will function similarly, but they will have a lower hurdle rate because they sit further along the risk curve. They take slightly less risk, but they want slightly less return in exchange for that sort of trade-off. A bank, on the other hand, or a regulated entity will work on a risk-adjusted return on equity model or a risk-weighted assets model effectively. So without going into lots of detail about that, there will be an adjustment for the expected loss of every single sort of customer on the portfolio. And that expected loss is based on, probability of default, exposure at default, and loss given default. And there's factors that play into that, that if you understand, you're able to sort of maximize the amount of return that a client could potentially provide to a funder. And therefore you can ensure that you get the lowest possible pricing, which is ultimately what everybody wants to do. But actually, the risk-adjusted return on equity model is important because you sort of look at, well, you look at everything that you earn from that customer, you take off your expected loss and you weigh that against the capital that you need to deploy effectively. And the key thing that I've said there isn't around max, saying, oh, well, my expected loss is going to be low because I'm lower risk than you think. And there is an element of that, but it's you take everything that that customer earns. And what you'll notice about banks, and they are still the majority of UK market, is that they have, a lot of ancillary facilities. They'll provide you with credit cards. They'll provide you with current accounts that you'll have transmission costs on. They'll provide you with foreign exchange. And those do get factored into those returns models if the bank's been notified about them. So when you look at a new transaction and you go out to the market and you might speak to 3 or 4 different banks, one of the things that you should factor in is these are all of the ancillary facilities that you would get if my business came with you, because when you do that, that does actually improve the pricing. And everyone's inclination is to say to the bank, could you knock a little bit off the margin? Well, the answer is they probably can, because they're not necessarily going to put their best foot forward first time round. But before asking them to reduce their margin, you should sort of ensure that they're capturing everything that you're actually paying them, because otherwise they're just getting that as free money. And not factoring it in, and your pricing is going to be higher. So if there's one thing you take away from the pricing side of this conversation today, it's that when you speak to your funders, do make them aware of any ancillary income that they would have with working with you. That mostly applies to banks and regulated entities, not to debt funds who just provide the debt as a commodity. But if we could just skip through the next slide, please, and just we'll just go on to the next one. So look, this just talks about when you speak to a funder, what they would like to see. And typically they're looking at sort of debt ratio. So debt to EBITDA ratio. This is where we talk, well, they'll give you 3 times EBITDA or 4 times EBITDA. It's mostly used as a proxy for cash, and how many years would it take you to repay if all of your EBITDA converted into cash. So 3 times EBITDA broadly means it's going to take you 3 years to repay that loan if you turned all of your EBITDA into cash. Now, we know full well that you're not going to turn all of that EBITDA into cash, and that it's going to take you more than 3 years to repay it. So it is just a proxy measure, but it's one that the market's relatively familiar with. Interest cover is something that I think has been forgotten over the years, and it's because interest rates were so low, but it's a good indicator of around how much you're actually paying to service the debt. And this is important because as a borrower, and I always say this, when you go out and take a loan, and whether it's a mortgage or a cash flow loan or asset-based lending or anything like that, you will have an amount that you need to repay as capital repayments and an amount you need to repay as interest. And often they're bundled as one, right? If you go in to take out a hire purchase on a car, they'll just say this is what your monthly repayment is. But there's a difference between them, because a capital repayment increases the equity value of your business. So if you borrow £1 million and your business is worth nothing, then your business is worth minus £1 million, because the debt has gone in. You've got the cash, and the debt sort of balance each other out. But you've taken £1 million out as debt effectively, and it deducts. As you repay that debt, the equity value increases. So if you generate cash to repay the debt, your equity value is going up, and that's creating value for the shareholders. Interest gets charged to your P&L, and it is leakage of value effectively. So the lower your interest rate, the less value you're leaking out of your business. So interest cover is effectively a proxy for how inefficient your loan is, or how much leakage you've got going out of your business. Now, obviously, someone's on the other side of that bet, and it's usually the institution measuring this stuff. So obviously, the more interest you're paying, the better for them in some respects. But obviously, there's a healthy balance between the two. And the final one, which is the most important one really for lending in my world anyway, is cash flow available for debt service, and that in ratio to your debt service costs effectively. And generally speaking, a funder will want to see you paying somewhere between 1.25 and 1.25 times cash flow cover. What does that mean? For every pound that you've got to pay the funder, your business is generating £1.25 to £1.50. That's broadly what that means. But those are just some of the metrics that funders will look at. And if you can check that your loan sits within those metrics, then obviously you'll know that you're likely to get it approved by a funder. So if we could just move to the next slide. we talked briefly there. I touched on asset-based lending as well. And look, I'm not going to go into lots and lots of detail about this. I'll leave this slide for people to look at. But there's a few handy rules of thumb here for when you're speaking to, whether you're a business owner or whether you're speaking to businesses. Um, you know, we'll talk about the spectrum of lending on sort of a subsequent slide. But the rough rule of thumb, I'll sort of spoil it now, is that you want to use your cheapest source of funding first, right? That doesn't sort of surprise too many people on this call. And your cheapest source of funding is usually your secured funding, because we talked about that loss given default. And actually, if your loss given default's lower, your expected loss is lower, and therefore your returns are higher. And this is also true for debt funds and the like as well, and asset-based lenders, is that they are looking to make sure that their risks are minimised and they price accordingly. So anything you can secure against the balance sheet is typically going to be cheaper than anything unsecured. So some rough rules of thumb for you. Look, realistically, with things like prescribed part and preferential creditor rules, you're not going to get 100% out of the stock. You're not, if you had £1 million of stock, you wouldn't get £1 million back in a downside scenario. So as a rough rule of thumb, you can apply, as long as you've got north of £1 million of stock. Anything less than that, and it's probably not worth the cost of implementing, you can probably get 30% of your stock as a rough rule of thumb. People say 50% of NOLV, which is net ordinary liquidated value. But the reality is that if you just use what's on your balance sheet and take 30% of it, that's a good proxy for what you might get out of a stock facility. For trade debtors, I use 77%, which is a 90% allowables rate and 85% advance rate. And some people will go higher than that, and you might have more higher allowables. So 77% is a good proxy. For plant and machinery, 50% of the value that's on your balance sheet is probably not a bad proxy. Although if you're taking out a new asset, you'll get pretty much 90% of that asset from a P&M point of view, from asset finance. So this is just about refinancing or using what's already on the balance sheet. And then for property, you can actually get 70 to 80% with some funders, but obviously, the lower you go on LTV, and a lot of people here will be familiar with mortgages. Obviously, the lower the LTV, the better the pricing is typically. So if we just move on to the next slide. So I've talked about the spectrum of capital, and this is sort of part two of three of this this sort of presentation. So the first part's just a bit of an overview of where we're at in the market and how the market might look at things. And if we just move on to the next slide, we'll sort of see, roughly speaking, what I call the spectrum of capital. And I find this is a very helpful visual diagram to share with clients, just to say this is what the spectrum of capital looks like. Now, everyone will be familiar with some part of this. Some people will specialize in asset finance, some people will specialize in property finance, some people will specialize in equity. And sort of what I head up, I call what I do capital advisory, not debt advisory, mostly because although a lot of people recognize what debt advisory is, I don't think it's a real job. And the reason I don't think it's a real job is because businesses don't need debt, they need capital. They've got projects that they want to complete on. They've got plans that they want to enact, and those plans require capital. And whether it comes from debt or equity is actually largely irrelevant. It's mostly based on actual circumstance and ultimately what's going to be cheapest to execute that project. So, when you look through the debt and equity market are two sides of the same coin. And you might say, well, hang on a minute, we have to start repaying debt from day one. You said earlier, that debt's more backwards looking and equity is more forwards looking. Well, that's just a function of the risk, generally speaking. As you go through the spectrum, the risk goes up, the cost goes up, and the amount of control that you have to give away goes up. And when you sort of go through the spectrum of capital, you might find that actually one of the things that I haven't mentioned there is that you've got to make a monthly repayment, or you've got to repay the amount that you give them, or actually there is a yield attached to it. And the interesting thing is you can have equity with debt-like characteristics and debt with equity-like characteristics. So what you might traditionally consider an equity transaction might be structured as a preference share with a participation at one times, which basically means you've got to repay that amount before you can access the equity structure below it. So that's very similar to making a capital repayment of the entire principal. It might have a yield attached to it, which is very similar to paying an interest rate. So, and obviously it will have some form of, equity shareholding in the business. But likewise, you can have a debt structure which has got a an equity warrant attached to it, so you've got to give away some equity. It'll have an interest rate attached to it, and you've got to repay the amount. And you can have a debt structure where the interest is picked effectively, payment in kind, which basically means that that interest isn't paid, it's added to the principal. So that then takes on more equity-like characteristics because it's not impacted on cash flow. So these structures are all one and the same, so to a degree. If you say, well, I don't want to have a big impact on my cash flow, you can structure something around that. Likewise, if you say, well, I want someone to be more forwards looking, we can structure around that. And if you say, actually, I just want the cheapest possible sort of financing, obviously, we can structure around that as well. So there's a lot of different options here. And that does mean that this market is quite complicated to navigate these days. I mentioned before that we've sort of got over 200 and I think it's 247 debt providers. I think we've got about 749 private equity providers as well. So you're talking best part of 1,000 institutions for us to navigate to sort of put some of this together. So it is exceptionally complicated, which is a good thing for me because it keeps me in a job, and that's what the real job is being able to actually structure around this entire market and understand where things are best placed. But typically, as you'll see as you go through this, the cost will go up and the risk will go up as well. So take, for example, at the relatively low end of the spectrum, property financing. And if you go out and take out a loan, as long, against your property, they might want to value your property. If you're a commercial business, they might want it revalued every 3 years. But as long as you keep up repayments, they'll generally leave you alone. If you go out and take a cash flow loan from a bank, then that's slightly different. I'll come on to that in a second. But go to equity at the other end of the spectrum, and they might want to sit on your board and tell you how to run your business. So those are the two extremes. That's obviously a lot of control that you're giving up there, and they will want a stake in the business and a share of the future profits and success. The cash flow loan that sits in the middle of those two and broadly in the center of this diagram, they might say, well, we want you to give us monthly management accounts and we want you to have quarterly covenant testing, and your EBITDA ratio can't drop below a certain level, or you've got to maintain your CFADS covenant to a certain level. And while they're not sat there telling you how to run your business, that does exert a certain amount of control on your business in terms of what you can and can't do. So you can't all of a sudden go out and start, changing completely what you sell. You've got to maintain roughly what the business did when you took out that facility. You've got to share with them your performance, and you can't deviate too much from your planned performance. So there's an element of control on your business as well. And the more control that's exerted, the lower the risk for the funder. And you'll see this as well in downturn scenarios. So this plays out, this dynamic plays out. If, for instance, a business's performance deteriorates and they might bring in their restructuring team at the funder, they might not say, we're going to put you into administration, but what they might say is, well, we want you to do X, we want you to do Y, and they'll start exerting more control. And that control reduces their risk effectively, which puts the management team under more stress and pressure, but it ultimately is a form of control that's being used to mitigate some of the risks. So you see that dynamic play out consistently in the market, in that when risk goes up, control goes up. And likewise, many businesses come and say, well, I don't want, I want my covenants to be fairly loose, or, and that's great. But if you want your covenants to be loose, that increases the risk. And that means that generally there's a higher cost associated with that. So in a traditional world, less covenant restrictions have typically been reflected in higher pricing. That's been particularly true in the past. And I know a lot of private credit and debt funds used to play on that particular dynamic. Back when interest rates were relatively low, to say we are a lot more expensive, but you've got, we're very covenant light effectively. And then there are other factors as well that make this dynamic quite complicated. For instance, the risk is much lower to a bank funder if there's a private equity house that sits behind them. So while you are having to pay quite a lot for the equity funding, you might find that there is a slight offset in the fact that your bank funding is cheaper, or that they give you more leeway and flexibility. So again, the spectrum of capital is, I say, universal in the sense that it is, there is always this interplay between risk, cost, and control with whatever type of capital that you try to raise. But actually, there's quite a lot of dynamic factors at play here that actually it's not a straightforward, okay, I'll just go and get a property loan and job done. I mean, that is a relatively straightforward solution. But if you're looking to grow your business, or you can accelerate your business growth faster, by taking out equity, that's something that needs to be factored in, and the cost needs to be offset against your business plan and your growth plan. And that is ultimately the point. If you're having to pay 10% interest for a particular loan, and you're only generating a 5% return on that investment, then actually that's a loss-making investment. You'd be better off not doing it. And those are, that's what I was talking about at the start of this presentation around businesses needing to learn the art of the business case again. And that's something that I think accountants can take away with their clients and sort of say, this is a service that we can offer you to help assess your business cases, because I think it's difficult for owner managers to be experts at everything. And that's why we have advisors and professionals. And, you know, the UK's got one of the best professional services markets in the world, right? And there's plenty of people on this call that are professional advisors, you know, that can sort of provide that level of service to the clients. So, you know, we should absolutely be selling that more, because it is an important thing as costs go up. And I think some of the indecision about investment and productivity gains and so on and so forth that sort of come out in the news, well, that's because businesses don't know whether or not they should invest, because they don't know whether or not the business case would work. And that's something we need to get better at sort of explaining to people and pushing. So if we could just move on to the next slide, please. And I've kept that. There's some key takeaways there around that. I think the only other thing is that, I mean, I'm an advisor. I don't take commission. So, you know, I obviously charge the client an amount, and that sometimes does catch them by surprise. I know accountants and lawyers have similar problems to me. What I will say is that, um, you know, if you're not paying for the product, you are the product. So there are sort of contingent only and broker-led models out there, and they absolutely have a place in the market, but the cost will be baked in there somewhere, whether it's in the rate, you're paying a higher rate and someone's getting a commission, you know, it just means you're not seeing it. So we like to be transparent and put our costs all up front. And I know a lot of people that are ICAW registered follow the same sort of principles there. But fundamentally, it's for clients there is an education piece here for clients about the way that this market operates, and understanding that there is always a cost to trying to do something, that they just need to know what it is. I think they're better off knowing what that is up front, and hence why we sort of portray our costs in that way. But fundamentally, these are some key takeaways, things that people might want to have a think about. If we could just move on to the next slide. So the other topic that everyone wants to talk about is succession planning. And why did I want to talk about succession planning while also going through, well, what does the debt market look like and what does the equity market look like? And the point really, if we can just go on to the next slide, is that business, why do owners sell their businesses, especially in the part of the market that we typically operate in, which is the lower mid market, you know, that SME market? You know, what you tend to find is that there will always be an element of people going, well, I don't want to pay lots of tax. I mean, that is obviously one thing that they say, but they don't go, I'm going to sell my business because I avoid a lot of tax. You know, people fall out, people fall ill, people get old. You know, those are typically the reasons that people sell their business. Um, they sell them because of life events. You know, my kids have just turned 18 and now's the time for me to move on, or I'm ready to retire, or actually I've fallen out with my business partner, we don't see eye to eye anymore and we need to sort something out, or it's a husband and wife business and they're going through a divorce. You know, all of these are common features that I'm sure anyone that's worked with a business that's selling in the SME space will probably recognize. You know, so actually, you know, there are reasons why people feel I've hit the plateau of where I can get to and I should sell now, and actually now's the right time in the market for me to sell my business. But typically people sell their businesses for a life event or an unplanned approach or something along those lines. So when we talk about succession planning, I'm not talking about here sitting down with a client and saying to that client, you know what, I'm going to sell my business in 2 years' time, and you know, when I do, this is what it's going to say. I mean, that's the gold standard that everyone talks about with succession planning. But the reality is, it's not going to happen, right? Because people sell because of life events. They don't sell because they've hit the right point in their business. So what I talk about when I talk about succession planning is having that plan that you can dust off when that life event hits, right? I'm not talking about sitting there and sort of planning out meticulously the day that you're going to retire or sell your business. I'm talking about when that happens, are you prepared or not? And if we could just move on to the next slide, and we'll sort of just go through these. So there's lots of different ways that you can potentially sell your business. You know, you can sell to your management team, you can sell to a trade buyer, you can sell to a private equity house, you can sell to an employee ownership trust, you can sell to someone that, you know, isn't in your business at the moment, or you can do some sort of public listing as well. And those are some of the types of sales that you can enact. And the circumstance of as to which one you go down will largely be dictated by what you're trying to achieve as an individual. And that's always where you should start really with regards to a business sale. It all comes back to that life event. What is it that you're looking to achieve? Are you trying to buy a house in New York? Is it just that you want a comfortable retirement? What is it that you as a business owner need? Because ultimately, a business sale is swapping that annuity of income from your business for a lump sum of cash. And I often say to business owners, you actually don't want a lot of cash. And they often laugh because obviously they do want a lot of cash, but cash is actually a pretty rubbish asset, if I'm perfectly honest. It doesn't generate a huge amount of return and it's incredibly liquid. And if you sell your business for £20 million, you probably aren't going to be able to spend £20 million in the next 24 hours. You might need, £500,000 a year to live off. Right. Well, how do you structure that? What do you do? So actually, selling your business should start at the other end in terms of what is it that you're looking to achieve and working backwards to there. And ultimately, if we just move on to the next slide, there's this just talks about time scales, but I mean in terms of selling your business, typically, there are going to be three factors that get played in. How much cash do you receive on day one? How much cash do you receive overall? And what's your legacy? Those are the three factors that business owners will have to take into account of when they sell their business. Now, how much they need on day one is actually largely a function of two different formulas. The first is how much you can actually get on day one, which is how much cash the business has got, how much debt it can raise, and how much equity the party that's buying your business brings to the table. And outside of that third one, I mean, business's cash and debt capacity are largely fixed. So ultimately, that final point about how much equity the party brings to the table is pretty key. And obviously, a private equity house has got much deeper pockets than your management team typically. But ultimately, the management team gives you a much stronger control over your legacy and maybe the overall value as well, because you can put more on deferred consideration. And a lot of advisors see deferred consideration as an unpromised amount in the future, whereas I see deferred consideration as the balance between how much you want to get overall versus how much you can get out on day one typically. And look, the markets are still evolving to deal with this. I still think that there is space for the UK market to grow in this. And there are more and more talks around things like insuring deferred consideration as well, which is still an emerging market where, there is appetite to explore that from insurers, but it hasn't quite got there yet. So we're starting to see people start to understand the complex interplay between those sort of various different factors. And I guess the other side of it is ultimately how much you actually need on day one. If you're about to buy a house somewhere overseas, you're going to need a certain amount of money for that. Well, that becomes a non-negotiable. If you want to do a management buyout and your business has got £1 million of cash in the bank and it can afford to raise £3 million of debt, and your management team have got 100,000 between them, well, you know what the limit is as to what you can get out on day one. Whereas, if the amount that you need is higher than that, that that's not a viable option for the sale of your business. Likewise, if you want to sell for a higher amount and just get it all out on day one, you could maybe look at private equity. But are you in a sector that private equity likes? Are you in a place that is where you've got good growth prospects? Because those are things that might factor in. Again, remember, equity want to get a 30% IRR. They want to double their money in 3 years, treble their money in 5 years. And if your business isn't in a place where that growth is possible, then obviously that route might be closed to you as well. So a typical exit timeline. The reason I wanted to look at this is because when that life event hits, you've sort of got to decide, well, I want to sell my business now, and usually you want to sell it tomorrow because that life event's hit and it all of a sudden becomes urgent. And that's why advisors will often complain about, well, we got bought in straight away and everyone wants things doing yesterday. And that's right, but that's because of the interplay between this emotional event that's happened in a personal life and ultimately the process that needs to take place. And unfortunately, timescales are stretching out with these sorts of transactions. It can now be 6 to 12 months to sell a business because you've got to get that information together. The business needs to keep running at the same time, and you've got to go through this process of approaching buyers, going through diligence, agreeing terms, getting the legal documents sorted, and that takes a lot of time. So you can do it quicker, and we are starting to see that there are things like AI that are bringing those timescales back in. But fundamentally, it's not a quick process from the moment that you make the decision to the moment that you sell the business. That can be quite a lengthy process and it's a draining process. It will take management's time and attention away from running the business. And I think the thing that sometimes we lose sight of is that it's quite an emotional process as well. Um, Obviously you have to start with what's right for the circumstances of the individual, but secondly, you've got to go that individual's going through an emotional time, right? It's a business that they've probably, built up over the last 10, 20, 30 years, maybe even longer than that. And the first offer they get on the table will always elicit a negative emotional response because it goes from being something theoretical to something very real. And people need time to process that and work through that. And I often say, um, you almost become, if you're going through a corporate finance process and looking at sort of a sale, you become an emotional counselor as much as anything else to the management team and the shareholders. And that's often quite difficult because a lot of people in this industry come from financial backgrounds where perhaps they weren't planning to be a psychologist, so a psychiatrist. So it's one of those situations where everyone sort of is trying to muddle their way through. But it's actually, as you build up that experience and you see it several times over, you know when to give people space and when to act as counselor to them. But we should never lose sight of the fact that this is a very emotional time for anyone going through it. It's like when a child leaves home or when a pet dies, that sort of thing. So people just need time to process it. We can just move on to the next slide. This just talks around what that sales process might include, and I think this is just useful for businesses to have a little look at. And I've sort of just alluded to that it does take that sort of 6 to 12 months and the various different steps that you might go through. If we just sort of move on to the next slide, because I do want to leave enough time for questions. That this is what I was talking about with that plan of early planning. Look, the earlier you start to plan for this, the more you can prepare. Obviously, tax planning is very important because the tax rate at, BADR, which at the moment, which is going to increase in April. We often get people saying, "Oh, we're going to try and rush things through before the budget or rush things through before April." I said, "Well, things will happen when they happen in this world, right?" But actually, there is an advantage that the earlier you plan that I might need to exit in the next 3, 4, 5 years' time, the sooner you can engage a tax advisor to make sure that your affairs are in order to minimise that liability. And there is a huge difference if you're planning to pass things over to your management team. There's certain schemes that you can put in place. Those sorts of things might have a sort of clawback period if things happen within the next 2 years. So it's always beneficial to make sure that you're well ahead of those sorts of things. But it's a bit like writing a will, is what I would say. Succession planning is more like writing a will than by setting a defined plan. It's just like when it happens, this is what I want to happen, and these are the things I need to do and put in place for it to happen. If we just move on to the next slide. Um, yeah, I think I'll just very quickly touch on value in businesses. People often say, "What's my business worth?" And the answer is, your business is worth what someone's willing to pay for it. Until you go out and test the market, you just don't know. But everyone's got a mate down the pub who sold their business for 20, 30 times EBITDA, and they've become a multi-millionaire. And there's people that have won the lottery as well. But everyone always tells you the rosy side. It's a bit like going on Facebook. No one ever puts all their bad stuff on Facebook. It's only ever the positive sides of people's lives. So, was it, you see these press articles as well, Silicon Valley values new business at £1 billion. Well, that's all well and good. But if you put £1 million in and to get 1% of the equity, well, actually, that you valued that business at 100 million, and that's all, well, 199 million actually. But the point is that, there's always a little bit of truth in there, but also it's exaggerated to not let the truth get in the way of a good story. So always take those valuations of what other people have said with a pinch of salt. I think fundamentally, a good advisor will give you a realistic view on the value that you could sell your business for and won't overpromise. And there are models out there where people do overpromise so that they can sort of sign you up to a retainer and actually never sell your business. And that's just it works for some people. It has a place in the market, but fundamentally, it is one of those situations where actually you want to have a realistic view of what you can sell your business for, and that's something that's important. But when someone tells you something you don't want to hear, they're probably telling you the truth. If we just move on to the next slide. Look, in terms of actually maximizing what you can sell your business for, there are things you can do. One of the things that I think you can do with accountants is speak about improving your KPIs. So, getting yourself a monthly board pack that you as a management or an owner can sort of understand how your business is performing so you can direct it and control it better. That also means that your information will be in good shape for when you do come to sell. So it's not about, well, I'm going to, these are the sorts of things that I would recommend a business does. It's not, it's a bit like sort of doing a home improvement. You're not doing the home improvement so you can sell your home for more money. You're doing it because it's nice to live in while you're there as well. And that's the same thing. You get yourself a good board pack. You get yourself a good monthly management set of monthly management accounts. You get yourself some professional advice. Those sorts of things are investments for the future. They make selling your business easier, but they improve it now. In terms of actually selling your business, reality is that you want to run a competitive process, and that competitive tension will mean that you end up at the maximum end of the sale value price. But that's something that you should speak to advisors about and engage with an advisor that knows what they're talking about and understands your business. And obviously, that's an important key aspect of that. We just move on to the next slide. I don't think we've got too many more slides. I think there's two more. So I talked about this already, so I won't go through it again, but this is the day one cash versus total cash, versus, your sort of legacy. And there is a trade-off there, right? If you sell to trade, it'll give you maximum day one cash, and they've got a lot of synergies. Synergies are another word for typically cost cutting, because that just enables the business to remove duplicate costs, which usually means people lose their jobs, which is usually negative on the legacy side. And in an emotional time for a business owner, that's something that they will need to factor in. So we'll sort of just that's something that you will need to factor in, is what are you comfortable compromising on in order to maximize the things that you would like to get. And then just onto the final slide. So the other thing is that you need to extract yourself from the business. So if the business is completely reliant on you to run, then obviously getting yourself out of it is difficult. And we often see this when people try and move on for life events. They say, well, I don't want to be in the business long term, but there's always a transitional period. So the more you can start to step away from the business before you exit it, the easier that transition becomes effectively. So that's just another thing to factor in. I think that's the last slide on succession planning. I'm sort of happy to take questions now. So we've got 12 minutes for questions, so I can sort of go through there.
Thank you very much, Scott. That was super interesting and an awful lot of insight in there. Just before we get going, I think I'm going to ask the team in the background running this if they could just share. There you go. The webinars that we've got that'll take us up to the festive break that you might be interested in. But Scott, so just to get us going here, we were talking earlier on in the week, and we talked about this phenomena of loan stacking.
Yes.
I thought that might be a useful place for us to start in terms of just talking us through that.
Yeah, sure. So that's helpful. So look, I think so first off, the way that the market is sort of set up effectively is that there is an inflection point in the debt market at around £1 million of debt. And when you go north of £1 million, people do a quite relatively robust credit process. Sub £1 million, you're into what I call the factor rate market, and these are the more the funders that will charge you an interest rate per month rather than per annum. So it might be 1, 2, 3% per month, and you've got lots of people who recognise in their funding circle, IWOCA, BizCap, Howgen. There's lots and lots of funders in that space, and it's largely accessed through the broker market. Now, there are a lot of brokers out there, and it's a relatively low barrier to entry, and that means that the range of quality amongst those brokers can vary quite a bit. And there's a lot of young guys out there that have sort of come in without a financial background who are driven by commission. One of the things that's interesting in the factor rate market is that they won't go around that sort of analysis that we talked about earlier in this presentation around CFADs and EBITDA and so on and so forth. Typically, they will look at two things. They will look at, well, three things. One, they'll look at the 6 months bank statements going back historically. Two, they'll look at can you afford the loan, and they'll look at your financial accounts. And three, they'll ask you for a personal guarantee. Those are typically what happens in that market. Now, one of the things you'll notice there is they're not saying I want to take out a debenture, and they're not sort of going in and looking at all of the other potential loans that you've got on the table. So if you are as a business asking to raise 2.5 million, and your debt capacity might only be a million, you can go out and get a loan for £500,000 from IWOCA. You can go out and get a loan for £500,000 from Howgen. You can apply to both of those at the same time, and they won't know about each other, and they're not going to ask questions about each other. And if you take them out at the same time, technically that's what's called loan stacking. Now, that's okay if your debt capacity is 1 million and you've taken out 2 loans of 500,000. But if you've taken out 5 loans of 500,000, you've all of a sudden put your business under unnecessary strain. Now, what you've got to remember is that the people that are providing those loans are incentivized to get as much debt out of the door as possible, which is not necessarily in line with the business's sort of best interests either. So we start to see with loan stacking a situation which actually puts the business into a precarious situation. And certainly I speak to our insolvency practitioners at Quantuma, and we're seeing more and more, and I'm sure there's a few accountants on the call as well, where they've seen their client and there's like 14 loans from various different providers, and they can't keep up with the monthly repayments. And ultimately the debt is a noose that's strangling that business. But yeah, we are starting to see that phenomenon more and more and more. I think it will become one of the next scandals in the industry, and there will probably be some regulation brought in to curb it at some point. But for now, it's something to be mindful of. And certainly anyone that's advising a business that hears them talking about, well, I could take out multiple loans at once, they should advise them to proceed with caution.
Thank you very much for that. Right, I'm going to jump straight into the questions that are coming
Yeah.
in, of which there's quite a few of them. So, Scott, so far you've focused on a single seller, but we're dealing with complexity of multiple owners with different shares, different ages. Any
Yes.
advice?
Yeah, I think, look, I said I've referred to single sellers, but I guess this is sort of um, a situation of complexities, right? We often see families in there, we see people that aren't related, and so on and so forth. Each of those individuals will have their own motivations, and usually what happens to create complex situations is where those become into conflict. So the first thing that I would typically do, and most businesses do have multiple shareholders, is understand the individual incentives of each one. I mean, I spoke to a business recently where there was someone that had gone through a health scare, and they obviously were going through sort of some chronic health situation where they wanted to extract. And we were approached by the other shareholder to say, I want to sell this business. And when I sat down and spoke to them, I said, I'm not sure you do want to sell this business. You think there's still a lot of process there. Have you thought about buying out the other shareholder? And ultimately the motivations of those two were different. Now, the more parties you've got, the more complex it becomes. But fundamentally, it's understanding what the motivations of each party are, and then structuring a solution that works for the entirety of those individuals. But without sort of going into their individual circumstances, I wouldn't know. And ultimately, those individuals might all need to take wealth advice if the business is worthwhile enough to understand what they all need, and then you try and structure something that meets the needs of all of them. The more people there are, the harder it becomes. That's why you need advisors typically.
Good stuff. Thank you very much for that. Right. So next question. I'm just going to read them as they've come in, actually. So what are the key trade-offs an owner must consider when choosing between a management buyout, a
Yeah.
trade sale, and a sale to private equity?
Yeah, sure. So, I mean, look, so typically, if I go trade sale first, trade sale, these are people that are prepared to pay the maximum value for your business. So you're always going to maximize value, which is that overall value. They're also usually able to pay quite a lot on day one, so they're going to maximize that day one cash position. But they are buying it for strategic reasons, typically because it fits with their business, and there are synergies that if you take a business making 1 million and another business making 1 million, together they might make 2.5 million. How do they make 2.5 million? You cut out 500,000 of costs. Where do those costs come? Getting rid of staff typically. So there's a trade-off with legacy effectively. With private equity, there might be more legacy preserved depending on the type of private equity house, and they might be able to pay more day one cash effectively. But obviously, they are going to drive the business harder. They are going to transform it. There's going to be more risk associated, and that business will be different to what you've done now. So there will still be a trade-off with legacy there, but not quite as sharp as with trade buyers. And on top of that, that private equity house will need to see that there are a lot of growth prospects in that business. So it's not something that's open to everybody. And obviously, if you go to a private equity backed trade buyer, the characteristics are more similar to trade than they are to private equity. So again, they're looking at those synergies and being able to pay you all on day one. A management buyout maximizes that legacy point, And it potentially allows you to maximize the overall cash out as well, because you might be able to say your business is worth £5 million, for argument's sake. You might be able to sell it for 6 to the management team, but only get 2.5 out on day one and take more over a period of time. So you might actually be able to get more overall, but you take less out on day one. Ultimately, the biggest issue with a management buyout is that that day one cash position is constrained, because the management team, unless they're exceptionally wealthy, are going to be restricted to how much debt they can raise and how much cash is in your business effectively.
Great, so thank you. Right, what else have I got here? So what specific actions can an owner take now to ensure their financial reporting is clean, consistent, and forward-looking for evaluation?
So, I mean, the first thing is that a lot of management accounts are bit parts or pulled out of Xero or SAP or Sage or whatever system that the business has got, and ultimately they're making decisions based on an extract from an accounting system. I think there are a lot of professional advisors, whether it's your accountant or other advisory firms, that can help you pull together a proper reporting pack. So the absolute key thing that I would do is what I call business readiness. And you can Google business readiness. There's lots of people that do it. We've got K3 Advantage, which does business readiness within our organization, so they can come out and help you with this as well. And the guys at K3 Advantage will literally go back to your trial balances and reconstitute your accounts from those. But also they will look at what is it that's the key driver in your business. Well, if you're a manufacturer of widgets, is it, how much production time you've got on? Is it the cost of materials? And monitoring those key performance indicators, the KPIs, that actually truly add value to your business. That's the important thing. Turnover doesn't add value to your business necessarily. There are other things that are factoring it, whether it's the performance of your staff, whether it is the way that your machines run, whether it is the cost of things that you're buying. There's going to be things that make your business successful. Understanding what those are and monitoring them is important. And you can't just do that with a Sage extract. Typically, you need to get yourself a proper reporting pack. So go and speak to your accountant about doing a proper management monthly reporting pack. That's probably the best thing you could do to maximize your business for sale.
Very good, thank you. I'm now very conscious of time and thought we'd have plenty of time to get through all of these questions. So
Okay.
if anybody's asked a question and I don't manage to get through it today, I will pass them on to Scott and he will come back to you after this session individually. I think I'm going to focus my final question for you on what is a pretty topical area throughout business generally. And the question reads, how is AI affecting the fundraising market?
So I think, banks are slow individuals. PE houses are sort of slightly more nimble, but people are still trying to get to grips with basically going into AI. And what I'd describe AI as is an over-exuberant intern with unlimited access to knowledge, effectively. So the market still needs to sort of professionalize itself in terms of what its workflows are, because everything is very done on a bespoke basis at the moment. But fundamentally, I think what will happen in the next 2 to 3 years is that things will become a little bit quicker, or people have more access to knowledge. I think as we start to move into the future, sort of 5 to 10 years down the line, we will start to see bits of the process being run, or credit papers being written by AI and decisions being made by AI and stuff like that. We're not there yet, and I don't think we're going to be there for another 5 years or so. But fundamentally, that will have an impact. What I think the biggest impact you're starting to see now is that with people being able to access that knowledge more easily, you're starting to see, more smaller private equity houses, rather than having to have economies of scale to make investment work. You have family offices able to directly access investments. So it's that matching process effectively that will then sort of become the key focus of the market, matching the right person to the right funder, because there will be more funders. So I think it will lower barriers to entry and ultimately improve access to funding, but we're going to have to go through a transition to get there.
Very good, thank you. That probably brings us to the end of today's session. Scott, we're going to get your contact details up onto the screen, I hope. Yep, there we go. So thank you very much to everybody who's taken the time to join us today and spend the first part of your Friday morning with us. We'll be back in a couple of weeks with a CPD session, I think, on commercial property taxes, which is always super popular. And I think that all that's left to say is have a great weekend, everybody. Thanks for joining.